Hey guys, welcome to BAP final review session for Accounting 201B, and this is session 1. So for session 1, we're gonna work on our chapter 1, 5, and 6. So let's get started with number 1. So using the traditional 3-part classification of manufacturing cost, prime cost, and conversion costs, have the common components of. So for this problem, we had to know 3 formulas for manufacturing cost, prime cost, and conversion cost. So manufacturing cost, the formula is going to be direct material plus direct labor plus manufacturing overhead. And for prime cost, the formula is direct material plus direct labor, and conversion cost, which is the direct labor plus manufacturing overhead. So it's really obvious. We can see that the one common component is direct labor. So the answer is direct labor. Direct labor is the only one element that's are all listed in this 3 formula. Okay, move on to number 2. In general, costs that can be most reliably predicted are. So for this problem, we have to know the 3 graphs. So the first one is the constant, the second one with the increasing slope, and the third one is decreasing slope. For the constant graph, it's only for variable cost per unit and total fixed cost. And with the increasing slope, it's for the total variable cost, and decreasing is fixed cost per unit. So most reliable to predict must be the constant one. It's just because that we only need to know because all the levels going to be the same, all the values going to be same at this point. So it's all going to be same, so it's much more easier to predict. So the answer is going to be the variable cost per unit and total fixed cost. But based on the answer choice that we had over here, we did not see the total fixed cost, but we only see the fixed cost per unit. So then the answer is just going to be variable cost per unit. Move on to number 3. So for 2013, the gross margin for Purple Company is $105,000, and the cost of goods sold manufacturing is $300,000, and the beginning inventory of work in process and finished good are $25,000 and $48,000. And the inventory of the work in process and finished good are $40,000 and $55,000. So it asks for the revenue of the Purple Company. So based on the given, we only have the gross margin, the beginning and ending inventory of work in process and finished good. And how can we find the revenue? So based on all the numbers is given, so the only way to calculate the revenue is by adding the cost of goods sold and the gross margin. So the problem already given us the gross margin, then we have just only need to calculate out our cost of goods sold. But cost of goods sold wasn't given in the problem, then we had to calculate it out. So we need to do is the beginning finished good plus the cost of good manufacture and subtract our ending finished good, and what's our cost of goods sold. And let's plug in with the numbers. Beginning finished good, it's the $48,000, and cost of good manufacture is right over here, it's $300,000, and the ending inventory of work in process. It's the finished good, then it's $55,000. So we plug it in. Plus $300,000, and we subtract the ending finished good, 50, and the answer we got is $293,000. So we plug this number into the cost of goods sold. We're gonna end it up with 193,000 plus our 105,000, and the final answer is going to be 398,000, and that's C. That's our answer. Move on to number 4. So they give us the flexible budget for the fiscal year and requires the cost of steam used in plants to be divided into fixed and variable elements. So the following data on the cost steam used and direct manufacturing labor hours, the DMLH, are used are available for the last 6 months. So for number 4, we are using the high and low method, same to number 5, high and low method. For number 4, we have to estimate the variable cost of steam per direct manufacturing labor hours. So with this one, we need to use the formula as the variable cost per DMLH, the direct manufacturing labor hours, is going to be the high cost subtract our low cost, and over the high hours subtract our low hours. What do I mean with the high cost and low cost? Is that based on the cost of steam, we can see the highest cost is in December, the 19 and 800, and the lowest one is 13 and 400. That's our cost, the high one and the low one. And look at the hours. The highest hour is going to be 3,650, and the low hour is going to be 2,050. So now we have the number. We just need to plug in the number. 19,800 subtract 13,400 divided by 3,650 subtract 2,050, and this is 6,400 divided by 1,600, and this is $4, and that's the answer. So which is C. And now move on to number 5. So assuming they're still gonna use the high and low method and estimate the amount of constant is. So with this, the constant, estimate the amount of constant. So we have to know that's the value that all gonna be used in like high point and low point. So for sure, if no matter you go with the high point or low point, you're still gonna get a same answer. So the formula we're gonna use is, start with the high first. So we know the highest cost is going to be 19 and 800. We just subtract with the highest hour, which is our 3,650, and we times with the variable cost per direct manufacturing labor hours, and we ended up with 5,200. And let's work on the low too. So the lowest is 13,400, and we subtract the 2,050 and times with the 4, which is we found in number 4, and we also end with 5,200. So the answer is A. And also, just for telling you about number 3, the beginning and inventory, work in process inventory are not included in this computation. It's just because the cost of goods manufactured, the 300,000, are includes the chart in work in process inventory. Just a heads up, I gave you some notes. And let's continue with our number 6. So the corporation budget sales are 320,000. Its budget variable expense are 180,000, and the budget for the fixed expense are 87 and 500. So it asks for the break even dollar sales. So the break even and dollar sale, the formula for this one, it's break sale in dollar is equal to our fixed expense divided by our contribution margin ratio. But in the problem, they doesn't really give us the contribution margin, but also we had to calculate our contribution margin ratio, which the contribution margin ratio is going to be contribution margin divided by our sale. So plug in the number that's given. So what is contribution margin? The contribution margin is also the sale subtract our variable expense. So it's 320,000 subtract 180,000 and divide by our sale, which is the 320,000. We're gonna end up with 43.75%. And we plug into the break-even sale formula. So the fixed expense is 87,500. And you divide it by 43.75%. You're gonna end with 200,000, and that's our answer, which is A. Move on to number 7. Use the following case to answer 7 and 8. Okay, so 7 and 8 are combined together. So the company produced a product that sells for $70, and variable manufacturing costs are $30 per unit. Fixed manufacturing costs are $10 per unit. Based on the current level of activity, the fixed selling and administrative costs are $8 per unit. A selling commission of 10% of the selling price is paid on each unit. So for this one, for number 7, we have to look for the contribution margin. So as we all know, the contribution margin is equal to sale subtract variable expense. Then what is the variable expense in this problem are including variable manufacturing cost and the variable selling cost. So the variable manufacturing costs are given over here, and this is the sale price, which is $70, but we did not see the variable selling cost. But in the problem in the beginning, it told us the selling commission are 10% of the selling price. So, which it means that $70, there's 10% of the selling price are our variable selling cost, which is $7. So we just plug in. So the sale is $70, subtract our $30 for variable manufacturing cost and plus the 7, and we're gonna end it up with 70 subtract 37, that is 33, and our answer is gonna be 33. Okay, the company had no beginning any inventory. A total of 40,000 units were produced and sold last month. If the sale increased by 200 units, net income would increase by. So there's a really quick formula you can use for this problem. So change is the triangle means the change. So change in net income. So in dollar equals the change in sale. So this one is in units, and times the contribution margin per unit. So given a problem that they increased by 200 units. So we'll put 200 and times the contribution per unit. But remember that we look for contribution margin per unit in 7, so we know it's $33. So you just times 33. So it's 6,600. That's that's our answer for A. So it's A. For number 9. So use the following case to answer 9 and 10. So for number 9, the company has no beginning or ending inventory. A total of 16,000 units were produced and sold last month, and the company margin of safety in dollar. So the margin of safety in dollar are equal to margin of safety in dollar. It's going to be so subtract our break even so. And the break even so was given a problem, so we also have to calculate the break even. So the break even, so I'm not sure, do you still remember? It's our fixed cost, the fixed expense divided by contribution ratio. And the contribution ratio also wasn't given, so the contribution ratio is just going to be our contribution margin divided by sale. So we have to work our number from the bottom to the top equation. Okay. So we know the contribution margin, 840,000 divided by the sale, 2,400,000, which is our 35%. And now 35%. And the fixed cost is our 630,000. And then we ended up with 1,800,000. And now we're gonna calculate our margin of safety. It's the sale, 2,400,000. Subtract our break-even sale, which is 1,800,000. We ended up with 600,000. So our answer is going to be 600,000. Number 10. So as for the company's degree of operating leverage, so the formula for this one is really simple, which degrees of operating, I'll just put the OL stand for this one. So which is the contribution margin divided by our net income. So look back to our chart. So the contribution margin is 840,000. The net income is 210,000. We just divided it again with the 4, and that's our answer for B. Move on to our 11. So the corporation provide the contribution formats income statements. The income statement is given over here. For July, the company produced and sell a single product. If the company sells 10,500 units, the total contribution margin should be. So what we're looking here is the total contribution margin with the given our new number of units sold. It's given right over here. So instead of using the 9,900 units, now we're gonna use our new one, which is the 10,500. Okay, how are we gonna calculate the total contribution margin for this problem? So first, we have to find the contribution margin per unit. So with the contribution margin per unit, we're just gonna use contribution margin divided by number of units sold. So with this, we plug in the number contribution margin is the 3,076 and 200. 200. You divide it by the original units, which is the 9,900. You're gonna end with the $38. And then you just times with the 38 with our new number units of sold. So 38 times 10, 500. You're gonna end with 399,000. That's our answer. A. For number 12. So the company have a single product and currently has a degree of operating leverages of 5. Which of the following will always increase the company's degree of operating leverage? So the operating leverages is the formula for this one. Let me write it. It's degree of L. So it's the contribution margin divided by our net operating income. And what is in our contribution margin? Contribution is the sale minus our variable cost and divided by the net operating income. So operating leverages measures the net operating income sensitivity to change in sale. If the variable cost per units decrease, so as variable costs decrease, it means that contribution margin is going to be increased. And if the contribution margin is increased, for sure that the degree of operating leverage is going to increase. Let me show you in numbers in case that you don't understand. So for example, the original contribution margin is 1, net operating income is 1. So for the degree of operating leverages is going to be 1. What if the contribution margin increase? For example, it's 2, and net operating income remain the same. Then our degree of operating leverage is going to be 2. So we can see the increase, right? So if this number increase, the operating leverage is going to increase. Okay, so we know that variable costs decrease. So that we know that the variable costs decrease, which is increase our contribution margin, which also increase our degree of operating. So for this one, we know A and B is not an answer choice. So it's going to be decreased. Now we can look at the total fixed expense. So based on this, the chart, you can also look at it. So fixed expense is the one you have to subtract everything. So it means that when the total fixed costs increase, which also gonna decrease our operating income. If it decrease, and it will increase our net operating income. So it's gonna be either one. So we just test it with the formula. So when let's see what happened when the net operating income decrease. So when we decrease it, we can see that the degree of operating leverage is going to be increased. And if you increase it, we're going to decrease the degree of operating leverage. Let's try with the number 2. So for example, the contribution margin is going to be 1 again. And net operating, this one's the original one, so it's still 1. So let's change it. So once the net operating income increase, and this one's net operating income decrease. Let me write it down in case you can show. So this one is increase, and this one's decrease. We can see that the number for net operating income, if it is increased, we're gonna decrease our degree of leverages. But if we will decrease our net operating income, we're gonna increase our degree of operating leverage. So based on that, we know that which one's going to increase our degree of leverages. It's going to be if we decrease our total fixed expense, which is increase our fixed expense. Because the fixed expense right over here, that determine our net operating income increase or decrease. Because we increase our fixed expense, we decrease our net operating income. And if we decrease our fixed expense, we're going to increase our net operating income. So you can look at this like this. So the answer is going to be C. We're going to decrease our variable cost per unit. That also going to lead to a increase in degree of operating leverages, and changing total fixed cost, we just increase it. We also going to increase the degree of operating leverages, because the question asks for always increase. So for the only correct answer is C. Move on to number 11. So Haley Company manufacture and sell the single product. The following costs were occurred during the company first year of operating. During the year, company produced 30,000 units and sold 24,000 units. So one is produced, one is sold. The company does not have any beginning inventory. The selling price of company produced is $50 per unit. Assume the company used absorption costing. What is the company first year net operating income or loss? So for absorption costing, the few things we included in our product costs are direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead. These are the only 4 things we included. But basically, we can see that our fixed manufacturing overhead are not in per unit, so we have to make it for per unit. So it's 360,000 divided by our number produced. It's just 30,000. We can end with $12. So we added up for our total unit product cost. It's going to be 7 plus 9 plus 3 plus our 12. Ended up with $31. And now we're gonna find our net operating income or the net operating loss. It depends on the number how we calculate. So we know the total unit product cost is 31. Okay, let's get started with the numbers. So in order to find the net operating income, which is the sales, subtract our cost of goods sold, and subtract our selling and administrative expense, and we ended up with our net operating income. So with sales, subtract the cost of goods sold is the gross margin, but I didn't put it, just make it like much simple to calculate. So the sale, it's given. So for sale, we need to calculate by using the sold number of unit that was sold and the selling price. The selling price is $50. So the sale is going to be 24,000 units times 50, which is 1,200,000. And the cost of goods sold, which is our product cost of 31 units, 24,000 times 31 is 744,000. And selling and administrative expense. Selling and administrative expense. It's our $4. We don't include the fixed one, so it's just only $4. So with the same units, the sold one plus times 4, it's 221,000. So we're gonna subtract subtract this two, and the final answer is going to be 235,000, and that's A. And that's it. Thank you for listening. Good luck on the final.